Let's explore the Federal Reserve's latest stance on interest rates and the labor market as Jerome Powell pledges to support strong employment. Also, we will dive deep into the short-term Phillips curve to see how these economic factors interplay, shaping future economic growth and stability. Don't miss out on insights. To understand the Fed's current policy decisions, it's useful to consider the concept of the Phillips curve, a key economic theory that explains the trade-off between inflation and unemployment in the short run. Introduced by New Zealand-born economist Almarin Phillips in 1958, the Phillips curve suggests an inverse relationship between inflation and unemployment. Based on his analysis of British wage and unemployment data from 1861 to 1957, Phillips found that periods of low unemployment often corresponded with high wage increases, and vice versa. Economists quickly expanded this idea to relate to price-level changes, specifically inflation and unemployment, leading to the formulation of the short-term Phillips curve. This curve illustrates a negative relationship between inflation and unemployment, implying that policies aimed at reducing inflation could lead to higher unemployment. Phillips curve gained traction among economists in the 1960s, a period characterized by the belief that the economy typically experienced either a recessionary or inflationary gap. An economy with a recessionary gap would face high unemployment and minimal inflation, while one with an inflationary gap would exhibit low unemployment and high inflation. The Phillips curve suggested a smooth transition between these two states. Thus, expansionary policies intended to reduce unemployment in a recessionary gap might lead to inflation, while contractionary policies to curb inflation could raise unemployment. The Phillips curve illustrates an inverse relationship between inflation and unemployment in the short run. The curve is suggesting that as inflation rises, unemployment tends to fall, and vice versa. However, key questions arise. What other factors influence unemployment? Has high unemployment resulted from widespread layoffs? What does soft landing mean in an economic setting? In this video, we'll analyze these issues and answer these questions to provide a clearer understanding of the current economic landscape. Stay tuned to uncover the answers. The Federal Reserve Fed plays a crucial role in managing the U.S. economy through its monetary policy decisions, particularly concerning interest rates and employment levels. As economic indicators fluctuate, the Fed is constantly balancing the dual mandate of maintaining low inflation and promoting a strong labor market. Recent remarks by Federal Reserve Chairman Jerome Powell emphasized the Fed's commitment to supporting the labor market, especially in light of the current economic conditions. Powell declared during his recent speech, "We will do everything we can to support a strong labor market." His statement reflects a shift in the Fed's focus from solely combating inflation to now considering the rising unemployment rate. The Fed, after maintaining high interest rates for over a year to curb inflation, is now preparing to cut rates, aiming to stabilize both inflation and employment. Powell's comments were clear. "We do not seek or welcome further cooling in labor market conditions." As inflation continues to cool towards the 2% annual target, the Fed has shifted its attention toward rising unemployment, which recently reached a near three-year high of 4.3% in July, up from 3.4% a year and a half ago. The Fed's decisions are guided by its mandate to ensure low inflation and a robust labor market, and Powell emphasized that the downside risks to employment have increased. Several Federal Reserve officials have echoed Powell's sentiments, suggesting that the Fed is now more concerned with stabilizing the labor market than it is with inflation. Inflation is now taking a backseat to the labor market, commented Ryan Sweet, chief U.S. economist at Oxford Economics. Additionally, Chicago Fed President Austan Goolsbee warned of concerned warning lights from parts of the jobs market, highlighting the delicate balance the Fed must strike to avoid further economic downturns. Despite concerns about unemployment, many experts attending the Fed's summer retreat at Jackson Hole, Wyoming, have suggested that the U.S. economy might avoid a recession. According to Karen Dinan, an economics professor at Harvard University, the underpinnings of the economy look good. Broadly speaking, things look pretty solid. She pointed out that unlike typical recessions, where there is usually an underlying weakness, the current economic situation does not appear to reflect such fragility. Dinan also noted that the recent rise in the unemployment rate could be attributed to a significant influx of immigrants entering the labor force. However, some experts have cautioned that the bond market's behavior indicates concerns about a potential recession. Thomas Honig, a former Kansas City Fed president, expressed his unease, stating that rapid rate cuts could lead to inflation surging again, even as the economy remains steady. In the current context, the labor market shows signs of both strength and vulnerability. Powell acknowledged that while unemployment has risen, it has not resulted from widespread layoffs, which are typical during economic downturns. Instead, it appears to be driven by an increase in labor force participation and a slowdown in the pace of hiring. He noted that the number of people losing jobs or getting fired remained remarkably low. This distinction is crucial because it provides the Fed with more flexibility in its approach to monetary policy. Given the delicate balance between managing inflation and supporting employment, the Fed is considering interest rate cuts in the coming months. Experts, such as former Kansas City Fed President Esther George, anticipate 2 3/4 point cuts this year, followed by a pause to evaluate the economic landscape. The goal is to achieve what former Fed Vice Chair Alan Blinder described as a soft landing, where the economy slows enough to curb inflation without tipping into a recession. The Fed's current focus on supporting the labor market while managing inflation risks reflects a nuanced understanding of economic dynamics. With the potential for interest rate cuts on the horizon and a careful watch on unemployment rates, the Fed's strategy aims to balance these competing concerns effectively. By incorporating insights from the Phillips Curve and closely monitoring both inflation and unemployment data, the Fed is attempting to navigate an economic environment fraught with uncertainty. As Powell emphasized, the commitment to maintaining a strong labor market is a top priority. We will do everything we can, he reiterated, to support a strong labor market. With this approach, the Fed hopes to foster stability and growth in the U.S. economy.